Hi there, and welcome to Living in Lansing, Michigan, your resource for everything you need to know about buying a home, selling a home, moving to the greater Lansing area, or just enjoying what we have to offer in the greater Lansing area. I am your host, Brooks Warner, local real estate agent with the Mint Home Team at Keller Williams Realty. Today, we are going to be talking about everything lending. Think about Lending 101. If you are thinking about buying a home and you are wondering what to expect from the loan process, that's what we're going to talk about today. And I have a good friend of mine and local loan officer who I've been working with for over a decade now. Joe White will be joining me to be our lending expert and answer all the questions that you need to know. So stay tuned. And before we get started, don't forget to like, subscribe, turn on notifications so you can see all of our future videos that drop. If you have any questions about anything that we talk about, please feel free to leave the information or leave your questions in the comment. I'll be sure to respond to you. You can also email me at brooks@minthometeam.com anytime. I'd love to answer questions and help you get prepared to buy a home. All right, I'm here with my good friend Joe White and local lending expert. Joe and I have been working together for over a decade now. He's going to help me answer some of the most common questions that we come across when working with buyers, especially first-time home buyers tend to have the most questions. And I think that we'll probably start with, when should someone contact a loan officer about getting pre-approved, like relative to when they're thinking that they want to buy a home?
Yeah, I've never really found it to be too soon for someone to get started. I think information is important to help get you started down that road. So the sooner you can find out what your buying power might be, or what loan programs you might qualify for, or what you need to tidy up before you're ready to buy a house, is all good information. So I think, as soon as you think you're headed down that road, get in touch with a lender and get started.
Okay, now in addition to that, I've had some clients be concerned about multiple credit pulls to get the mortgage for what it's going to do to their credit. Rather, it's because they're not going to buy for a while and they're going to need another one to get through the process, or if they want to shop other lenders. Do you have any information that you could share with buyers about that?
Yeah, so if there's a difference between a soft credit pull and a hard credit pull, and that's really the big distinction. So if I do a soft credit pull, which I pretty much do on every pre-approval, because there could be a huge lag time before they're under contract, that soft pull will not ping the credit bureaus in the way that a hard pull will. So that's usually the way we start, because it kind of gets you the same information that we need to get started with without actively hitting your credit. So I would say that, that's a great way to start. So if, whatever lender you're working with, I would encourage them to do a soft pull rather than just auto doing a hard pull, which a lot of them will. When it comes time to do the hard pull, you can actually shop with unlimited lenders for 45 days and not have it impact your credit score. So there is a built-in shopping period for mortgage-related credit pulls. So that helps too.
Awesome. Another thing that I get a lot, and I don't know if you do, Joe, is what type of loan is right for me? There's a lot of different ones out there, and obviously that's going to depend on the person's circumstance, but maybe you can give us a little bit of overview of, 4 or 5 of the most common loan types and the pros and cons to them, and kind of go from there.
Sure. Most popular loan type is just going to be a conventional mortgage. Those are overseen by Freddie Mac and Fannie Mae. Those are the ones where if you put 20% down, you're not going to have PMI, but as a first-time home buyer, you can do as little as 3% down or any amount above that. So conventional mortgages are very popular for generally better credit customers. For lower credit, you might be looking at an FHA mortgage. Veterans can certainly utilize VA programs, which are awesome if you qualify for that. There's also rural development, which is a true zero down program. Has to be in the right geographical area, but it's a great program, good rates, no money down, reduced PMI. So that's a great one too for people that are kind of short on the funds needed for closing.
Yeah. And as far as the geographic area for the rural development, a lot of the greater Lansing area is covered by it, right? Like City of Lansing is not, but most of the suburbs and outskirt areas are covered by the rural development law.
Yeah, it's
correct?
more than you think. You think rural and you're like, oh, I'm out in the boonies, but it's really like almost all of Lansing does not qualify. Most of Okemos, Holt, parts of East Lansing don't qualify. Almost everything else does. So, I mean, it's a huge area. It's a great program. And they move quicker through underwriting than you think, as long as you're working with a lender who's rural development savvy.
All right, Joe, so you touched on down payment a little bit with the conventional loans. If you're a first-time home buyer, you can go as low as 3% down. If you're not a first-time home buyer, how much down do you need to use a conventional mortgage?
It just moves from 3% to 5% as that minimum. There's always been a stigma of, oh, I need 20% down to buy a house. It's absolutely not true, as we just went over. VA and rural development are 0 down programs. FHA is 3.5% down. Conventional is 3% for first time, 5% for non-first time. It's just obviously the more you put down, the cheaper that payment will ultimately become, but certainly not a requirement to go above those minimums.
One other thing that I want to kind of throw in there, it's not technically a different loan type, but it is something that comes up fairly often, is MSHDA. Why don't you tell us what MSHDA stands for, how it works, and a little information about that?
Yeah, it's the Housing Development Authority in the state of Michigan. They have down payment assistance programs that can kind of ride along with FHA or conventional buyers. And that's just going to be down payment assistance. It can be used for the down payment. It can be used for closing costs. It's not something that everybody needs or has to do. They do have credit score minimums of 640. They have income caps. They have purchase price caps. So there's some rules that come along with it. The money that they give you is not a grant. It's actually acts as a second lien on your title for 9 years. So that's a part of the decision you're going to have to make if you want to use that down payment assistance is, can I buy something with no strings attached? If you consider that second lien to be a string, maybe that's something that you can avoid. But truly, some people, it's the perfect loan program for, and it's like I said, it rides along with those other loan programs. So you're going to get good rates and all the things that come along with that. So it can be a very valuable product if you need it.
There are other down payment assistance programs out there, but they kind of come and go. So It would be more based off from when you're getting pre-approved. If you think that's something that you could use for help, you need to ask your loan officer if there's anything unique, special for the time period that you're shopping that would qualify.
Yep, it's absolutely true. I mean, there's the city of Lansing does a grant. Like if you work for the city and are buying in the city, they'll give you a couple $1,000s. Just that's free money. But yeah, it's just something that you have to make a decision on and see what's available. Even MSHDA will change how much is available. Remember, they did that $25,000 rollout for a while. That was huge. And it went away very quickly because a lot of people used it fast, but it's bounced between $7,500 and $10,000. So you just have to see what's available at the time you're going into it.
Okay, Joe, let's talk credit score. Pretend I don't know anything about buying a home or getting a mortgage. What type of credit score do I need for the different types of loans? What variables are there that I should be considering?
Yeah, I mean, we can go really deep into the weeds on that because it's not an easy answer. Conventional mortgages, which are backed by Fannie and Freddie, they just kind of removed that floor of a 620 credit score. You can actually go below a 620 on a conventional mortgage now. The lower your credit score is, you're going to need what are called compensating factors to overcome that low score, such as a strong retirement balance or really good debt to income ratios or something else to offset that low credit profile. But technically a conventional mortgage, you can go quite low now. With an FHA mortgage, you can technically go all the way down to a 500 credit score. Below 580, you're going to need 10% down instead of that 3.5% down that is required above a 580. But again, you're going to need some pretty strong compensating factors to get approved down that credit range because that's looked at as a negative factor. So, from that standpoint, I would say VA is going to be the most friendly with credit scores, generally speaking. You can go pretty low on that and still get an approval with $0 down. Rural Development's generally the most strict underwriting platform. They look really hard at debt to income ratios, and you have to have excellent credit to kind of go above their pretty conservative debt ratio caps. So it really does depend on every circumstance. There's no cookie cutter answer. You might run one scenario through Fannie Mae's underwriting system and it takes it with a 680 credit score, and it might not take the next one just because their assets aren't quite as good or the debt to income ratios are too high or whatever it is. So a lot goes into the credit score needed to close, which I think is why it's important to start that conversation early on pre-approval and figure out what you may be able to do or what you need to fix to get there.
Okay. So what I think I'm hearing you saying is potentially as low as 500, but you would have some additional hoops you'd have to jump through or have to have some additional assets, but typically more around the 620 it
gets easier at that level.
Okay.
And when I'm talking about conventional loans being below a 620, you're going to need at least 20% down at that point.
Okay.
Even at that 620 number, you're probably not getting it through with less than 20% down. So it's about what's the overall strength of the file, and then what other positive attributes does my file have to overcome some of the potential weaknesses. And it just all gets kind of blended together, and they say yes or no.
All right, Joe. Well, I know these are not static and they are fluctuating all the time. Let's talk a little bit about today, January 15th, 2026. What can someone expect from an interest rate standpoint?
Yeah, I mean, and it's not only static day, or it's not static at all, and it will rotate day to day. It can go up, it can go down, but also, one person's conventional mortgage interest rate could be different than another because their credit score is lower or they're not putting as much money down. So every scenario is different as well. Generally speaking, on a conventional mortgage, rates are going to be in the low sixes right now, but you can see them, trend toward the upper sixes if you have a lower credit score and not quite as much money down. So file attributes very much matter in terms of what interest rate you can get. The trend has, fortunately, over the last 6 months or so, moved rates down a little bit into the low sixes, generally speaking.
Okay. Now, Joe, low sixes is kind of what we're seeing with people who have really clean files today based off from what you just said. Could be higher than that. Do you have any predictions of what you think we might see throughout this year?
Yeah, I mean, I generally try not to predict because over the last couple of years, almost everybody who's tried that has been wrong. I will defer to our chief secondary officer at Van Dyke Mortgage, who his job is to monitor those markets and see what factors might change the rate market. His expectation in 2026 is that we might see rates kind of drop to the mid fives or high fives at some point. He doesn't expect fours or low fives. But again, there's a lot of factors in the market and the political climate that can change things very quickly. So if something pops on that front, we could see rates take a dive, and then it's, time to maybe jump in on a refi or get a little more serious about buying that house.
Yeah. And on the flip side, there are also those same factors could go the other direction and drive interest rates back up to where they were a year ago, closer to 7, right?
Absolutely.
So there's no way to know for sure. A little bit out of the lending circle, but I kind of tell my clients that if now is the right time for you to buy a home, the interest rate is going to kind of be what the interest rate is going to be. So base your decision more off from what is right for you as opposed to trying to time the interest rates, because that's frankly impossible.
Yeah. And I think a big thing too that we see, especially with first-time home buyers, is they wait because they have this perception that rates are too high. Even when rates were 7.25%, if you're in a rental and you wait a couple of years to see rates come down to 6, the amount of appreciation and equity that you've lost in those couple of years is far surpassing what you would have saved by a 1% lower interest rate. So you really want to look at the overall economic impact to your financial situation while you're making that decision of when's the right time to buy, because it's almost always a better time to buy than it is to rent.
All right, let's talk a little bit about the documents. If someone wants to get pre-approved this week, what things are they going to need to give their loan officer? What should they be gathering, making sure they know where it's at or can quickly find if needed?
Yeah, the pre-approval process can be very simple. It can be very detailed. It depends on the applicant's work history, what they're doing now. Generally speaking, if you're a W-2'd worker, which most applicants are, you're going to need a W-2 or 2 from the year or 2 prior. You're going to need a couple of pay stubs, bank statements, identification. The basics like that are generally enough to be able to work up the file. It can certainly get more complicated for self-employed applicants. We're going to need tax returns at that point, sometimes profit and loss statements, business bank statements, things like that can come into play that wouldn't for a non-self-employed applicant. So it really does depend on who you are as a potential buyer, but as long as the lender knows what they're doing and what program we're kind of heading toward, they should be able to guide you more specifically to what we need instead of saying, just give me all of your documents. That's not super helpful.
Yeah. And as someone, I know that you take most of the stuff through an online portal, as most lenders do now. And from my recent experience, I can tell our viewers that the online portal will ask for an absurd amount of documents. Yep. And I believe that it's pretty safe to say that a lot of that doesn't apply to everyone. So it's kind of like a ask for everything, but the actual applicant may only have a handful of the things that are being asked for.
Correct. So what I try to do there, just as a loan officer myself, is to try to either we can customize what the portal's asking you for, which is a great way to start, so it doesn't ask you for everything, or if we weren't in a position to customize it, at least follow up and say, hey, I really just need these couple of things to get started. And then once you're under contract, we can get the rest of it. So you kind of just need to know as a loan officer what it is that client needs to get to that pre-approval stage and start there.
How long typically does it take to do a pre-approval for someone? Now, obviously, I'm sure that there's variables just like everything, a self-employed person versus a W-2 person. But in general, if someone says, Joe, I want to apply for a mortgage today to get pre-approved, what's the average turn time someone can expect?
It's a tricky question because my average is probably different than other lenders. I've been doing this for 22 years now. If you're a W-2 worker with a pretty simple file, I'm probably done in 15 minutes. If you're, someone who's self-employed and we have to do a bank statement loan for you, that's probably going to take a couple of days, just depending on how quickly we can get all of that information in and reviewed and signed off on. So it really does depend, but if it's a pretty straightforward file, it's very fast.
So if they apply during business hours, you're looking at same day turn, next day worst case scenario for a standard file, maybe a couple of days for the more complex stuff.
Yeah, absolutely. And the nice part is you'll know that we reviewed it. There's certain online focused lenders that will pop out pre-approval letters without doing a thorough or any type of review of the file. And those pre-approvals aren't going to carry as much weight as something that we send over where we've actually looked at your documents, signed off on them. There's language in our pre-approval letters that says that we've reviewed and signed off on those documents. So I think that adds a little bit larger measure of credibility when you go to make that offer, and the seller side will see that and know that your file is more solid than maybe some online lender that they don't know or trust quite as well.
So kind of like that kind of ties nicely into like a pre-qualification versus a pre-approval letter.
It does. There is a difference.
Yeah.
I tend to lean more towards pre-qualification letters and the language associated with those, but at the same time, some files are less certain than others, and that's where I have to get underwriting involved, and we can actually do what's called a TBD underwrite, to be determined, what the property address is, but we're underwriting the credit application and the income documents so that if it's not something where I as the loan officer am absolutely certain that we're good to go, then we can get it through underwriting and they'll sign off on it, and then we know for sure that it's good.
Yeah. So you just mentioned underwriting, which was one of the things that I want to talk to you about today. I imagine a lot of people don't really understand what that process is or what it looks like. So could you maybe explain what underwriting is in general?
Yeah. I mean, they're kind of the gatekeepers that are allowing us to get to the closing table. And every file is going to have certain boxes that we have to check in order to get to that closing table. It's going to be the appraisal, the title documents, home insurance, the income documents, the asset documents, all that stuff. So my job and my processor's job is before the underwriter sees that file, we're getting them as complete of a look at that file as we possibly can. They're going to go through it and say, okay, FHA said we need this, or Freddie Mac said we need these things. And once they've reviewed that, they're going to kick it back to us and say, hey, we need to gather the rest of these documents from your buyer. Once we satisfy those, then we can move to closing.
So it's almost like a double checking piece of the mortgage industry to get someone else's eyes on it, to really look at everything with a kind of a fine tooth comb and make sure that there's nothing's been missed.
Absolutely. And there's a bunch of reports that get run in the background of a file that the realtors don't see, the buyers don't see. That we're running fraud reports that include identification history, property history of any home you've ever owned or lived at. So there's a lot going on that we have to check and make sure that there's really what it is, a lot of it is we're just making sure that no fraud is active on the file and then checking those boxes to get us to the table.
So you just kind of mentioned it in passing in underwriting, from the underwriter approving the appraisal. Why don't you talk to us a little bit about what an appraisal is, how the appraisal system works? Kind of give us an overview on that.
Yeah, that's been expanding a little bit too. It used to be just, hey, order an appraisal. The appraiser goes out there, checks the condition of the home, finds similar homes in the last 6 to 12 months that have sold in that same area, comes up with a value, and then kicks the report back. So that would be like a standard appraisal. And for that, we would order that through our appraisal management service, and they will randomly select a local appraiser to go perform that report that's approved in our system as an allowed appraiser. And then they contact, the listing agent to schedule that appointment, go out and do that. But the Fannie Mae and Freddie Mac have kind of evolved that process a little bit. So there's different appraisal types that we can do now that are maybe a little quicker or less invasive. There's hybrid appraisals, there's desktop appraisals, there are what are called property data reports. A couple of those they don't even go into the house. They're just doing more of a, yes, this house appears to be in good condition, and then checking the comps. And the property data report doesn't even check comps. It just kind of says, yes, what you're selling this home for appears to be accurate. So,
and I guess this is kind of my personal take on it, but a lot of buyers seem to think that the appraisal is for them, and in reality, it's for the bank or the lending institution to make sure they're making a good investment in lending money on this property.
It is, yeah. I mean, if you're buying a house for $300,000 and the appraiser says it's worth $260,000, the lender's going to have a problem with that.
Yeah.
So we kind of have to go back to the table at that point. But yeah, I mean, in general, that's how it works. The one exception would be VA loans, which Brooks and I work with a lot of veteran clients, and VA has their own appraisal portal. So we actually have to order it through the VA. They will pick a VA-approved appraiser to come out and do that report. And the timelines aren't quite as strict as they would be if it was ordered through a lender like Dyke. But generally speaking, they turn them around pretty quickly and do a good job with that.
So we've talked about a few of them, but what would you say the main ingredients are, the main things that are looked at for a buyer getting approved for a mortgage?
Yeah, it really just kind of comes down to three things. It's going to be the credit profile and credit score, which we've talked about, your debt to income ratios, and then also your assets in terms of like how much are you putting down and where is that money coming from.
Okay. So yeah, down payment and credit score we've talked about quite a bit. Tell us a little bit about debt to income ratios. What is it? What type of ratio does it take to get approved? What things count towards your debt for debt to income ratio? That type of stuff.
No, that's a great question because that term can be a little confusing. Let's say you have an applicant who makes $5,000 salary every month. As a lender, we can, like on a conventional mortgage, Fannie Mae and Freddie Mac won't take more than a 50% debt to income ratio. What that means is you take the $5,000 gross, you divide it by 2. That's the 50%. So we have $2,500 a month to work with. And let's say you have $500 worth of car payments, minimum credit card payments that are due each month, and some student loans. That brings it down to $2,000. That $2,000 is what you have to spend on a house. So that's kind of how you would be maxing out your buying power in a scenario like that. And of course, as much less than that $2,000 max that you can use, the better for budgeting and affordability and things like that.
Yeah. So you mentioned car payment is a common one. Student loan debt is definitely a common one. Yep. What about utilities? Are there any other debts that people should be concerned with when it comes to debt to income ratio that maybe they're not thinking of?
Part of the reason they divide it by 2 is that top half that we're not using is going to be things like your car insurance and your utilities and other day-to-day bills like that. The portion that we get to use, it's going to count any mortgage loans that might be on your credit report, car loans, student loans, credit cards, any personal notes that you took out at a bank, things like that. So installment loans, revolving debt, and mortgages are kind of the main 3.
Yeah. What about like furniture loans? If you go and do a payment plan through, does that stuff show up on?
Generally, that's going to be on some type of a credit card repayment.
Okay.
So that would be a revolving debt, and that would count against your buying power. Yep.
And I've had this one before. Rent for their current home or current apartment. Does that count or does it not count?
It does not count if you're going to be occupying that home you're buying as a primary residence. If you're going to be not doing that, let's say you live in a rental but are actually buying an investment property, which happens. That rent does count against your debt ratios because that's where you live, and we have to count that housing payment. So it kind of depends on what your intentions are with that home. Generally speaking, if you're renting for the purposes of owning and living in that home, then that rent you're paying now would not count against your buying power.
Okay.
It does. Sometimes what we'll see is people that will try to be building their credit with like a utility bill that reports to the credit bureaus. We can exclude those from our debt ratio calculations. Okay. So you'll see that like they'll have their cell phone bill or their consumer's bill reporting to the bureaus to try to help build up their credit score. That does show up on the credit report, but we can exclude those.
So that was news to me. That's not one that I had ran into before.
Yeah.
Another question we get all the time is, what the heck is PMI and how do I avoid paying that pesky thing?
That's part of where that 20% down payment mantra comes from. So it really does depend on the loan type that you're doing. PMI is private mortgage insurance. It's kind of a lender protection thing for files that are considered riskier. And that phrase can sometimes take on a negative tone because you could have someone with a 790 credit score and they're only putting 3% down on their first home that they're buying. Lenders will consider that a little riskier because there's not as much equity in that house. So they're going to make you pay PMI, that private mortgage insurance, until you reach a 20% equity position in that home. On conventional mortgages, once you get to that level, that PMI will drop off of your payment. FHA mortgages have a mandatory PMI that never goes away. So the only time that would go away is if you refinance to a conventional mortgage or sell that house. VA mortgages have no PMI, and rural development mortgages have a reduced PMI that will sit there as well.
But that stays forever, like the FHA one for rural development, correct?
Yeah.
I know that it varies a lot on how risky the file is. In general, how much is PMI costing the average?
So PMI used to be a lot simpler, and as everything else in the lending industry, it's gotten more complicated. So now your debt to income ratios are a factor in the PMI rate. Your credit score is certainly a factor. The loan size is a factor because it's a formula that comes up with a percentage, and that's what becomes your PMI. So let's say you're buying a $200,000 house, you're putting 5% down, and you have 780 credit. You're probably looking at about $50 a month, $60 a month in PMI. And the more you put down, the lower that will become. Let's say you're that same buyer, but you're putting 15% down, but not quite to 20. You're probably looking at $15, $20 a month of PMI. Okay. And then it'll go away faster too, because you're closer to that 20% mark when you start.
So kind of just like the fluctuation of what a specific buyer gets for interest rate, yep, the PMI is going to kind of work the same way, it sounds like.
Yeah. So if you have a lower credit applicant buying a large home with a minimal down payment, I've seen PMI be as high as $500 a month. And that's just what it took to get those deals done. And then the goal obviously becomes, if their PMI is that high, they also have a higher than market interest rate. So the goal is, let's get their credit scores moving in the right direction and ultimately refinance them so their rate and their PMI can come down.
All right, Joe, there's been a lot of talk over the last couple of years about buying points because we went from insanely lowest in history interest rate back to what is actually an average interest rate, but feels really high considering where we were for a while. So the conversation around buying points to get your rate down became pretty popular. Why don't you explain a little bit about how that works and what your thoughts are?
Okay. So a lot of people don't know what points are. They've heard the term, but they don't really know what it means. So like on a $200,000 loan, 1 point is $2,000. It's going to be, that's how that works. So if it's half a point, it would be $1,000. So what that is when you go to buy a house, you're going to get a loan estimate. And on page 2, box A of that loan estimate, you're going to see the origination charges. It's going to include things like application fees, processing fees, underwriting fees. Lenders have variations of what they charge and what they call it. Also in that box, you can see added origination costs, which are known as points. The general idea behind points is that you're using it to buy down your interest rate. So like, let's say we're at 6.125% today and you want to pay a point. That probably gets you down to 5.875 or something like that. So you're saving an extra, $40 or $60 a month, depending on your loan size. And it costs you, let's say it's that 1 point at $200,000, it costs you $2,000 to save that $40 to $60 a month. Then the idea is like, well, how long does it take me to recoup that $2,000 by that savings I got? The other big piece to that is if you buy a house with points, those points are added closing costs that you're bringing to the table. Let's say you're buying a $400,000 house and you paid 2 points. That's $8,000 that you brought to the table in addition to all of the regular costs and settlement charges that you would have to bring. And then let's say the reason you did that was because rates were high. Let's say rates come down a year later and now you want to refi. that $8,000 is up in smoke at that point.
Yeah, you just burnt that money.
You did. So I'm in a higher rate market, as crazy as it sounds. A lot of times it makes sense not to pay points if the expectation is that rates are going to come down to a more refinance friendly market, which is kind of what we've been in the last couple of years. So I've been counseling people not to do that unless they absolutely needed to, because anybody who bought a house from 2022 to 2025 was on our refinance watch list to try to get them down to a better product.
Yeah, and not just refi. If they're thinking about moving, if it's a short-term purchase, they only plan to be there for 3 to 5 years, like the math might not work out on that as well, too.
Sometimes it can take you 8-10 years to recoup those points you paid at closing. So you really want to do the math before committing to that. And you also want to make sure that your lender, if they're trying to charge points on your transaction, are doing it for the right reasons. Like we've had many transactions over the years, ones that we've worked on mutual clients with, where I was able to get that buyer the same exact rate with no points as another lender was giving them that same rate with $5,000-$8,000 in extra closing costs. So there are still some lenders out there that are, trying to make as much money as they can on every deal at the cost to the customer. So that's kind of something to watch out for too, is like make sure that that's moving you below market rates, because that's the whole point of them.
Okay. And then along with that, you kind of got into it already. So let's jump to what are closing costs? What can someone expect their closing costs to be if they're saving up to buy their first home or whatever?
Yeah. The bad news on that front is all the credit reporting agencies are raising their fees once again by a pretty good number. So the hard costs kind of been going up and up the last several years, and that's not really been any fault of the lenders themselves. In some cases, it's just what the market is bearing out. So closing costs is the phrase that you hear. Really what it is settlement charges. And settlement charges are broken into 2 categories: hard costs and prepaid items. Your hard closing costs are going to be things like your underwriting fee, your appraisal fee, the title company's fees, title insurance, recording fees, things like that. Right now, if you're not paying any additional costs like points, you're probably somewhere between $3,000 and $4,000 for your hard costs. A big swing factor in that can be if we get an appraisal waiver, which sometimes happens. That can save you, $500-$600, however much that's going to cost. So that's your hard costs, which you need to plan for. And then your prepaid items, which you also have to plan for. That's going to be when you buy a house, you have to pay the first year of homeowners insurance up front at closing. You're going to have daily prepaid interest through the month of closing. So if you close on March 15th, your first mortgage payment's not due till May 1st. So you have to cover that May 1st payment's covering April's interest. That March 15th closing, you need to pay the March interest. So you're paying that March 15th through March 31st daily interest, which can add up to be a big number. And then if you want an escrow account for your taxes and insurance, you also have to pre-fund that at closing. So those additional prepaid items can be several $1,000s depending on taxes and insurance amounts.
Yeah, so let's talk about that a little bit. What is an escrow account? And then we'll kind of jump back into how that can affect your closing costs, because property taxes nowadays make a huge impact on closing costs. So what is an escrow account for anyone who might not know?
Yeah, the nice part is you can, if you're putting 20% or more down, you can opt out of having an escrow account, which means you're paying your tax and insurance bills separately from your mortgage when those bills come due. If you have an escrow account, which you will have to have if you're putting less than 20% down or doing an FHA, rural development, or VA loan, you have to have escrows. So what that means is on top of paying your principal and interest and potentially your PMI every month, you're also paying a prorated share of your taxes and insurance as part of one lump sum payment. So let's say your principal and interest is $1,500 a month, but your 1 month of your taxes and insurance is $500 a month, then you're paying $2,000 a month to the lender. They put that extra $500 into your escrow account, and when your tax and insurance bills come due, they pay them for you. You'll still get copies of the bills, but they will pay that out for you so that you can see the activity.
Gotcha. And how much of the taxes have to go in the escrow account at closing?
Depends on when you close. In Michigan, we have winter and summer tax bills. So sometimes it can be 3 months of the winter bill and 9 months of the summer bill. It just depends on where we are in that year. You'll notice a lot of out-of-state lenders will not know how we do it in Michigan. And when they're sending you numbers, they're sending you very inaccurate escrow setup numbers. So it is important to have a Michigan lender if you're doing a Michigan transaction, because we're a little different how we do our taxes.
But it sounds like it's typically at least a few months are going in the escrow account that you're going to be responsible for at closing. So if your property taxes are $6,000 a year, which is actually on probably the lower side of property taxes nowadays, you're going to have $3,000 to $6,000-ish dollars
somewhere in that range,
and putting into your escrow account for closing too, it sounds like.
Yep, absolutely.
Okay.
It can be a significant factor to what you're bringing to that closing table, because a lot of people are just thinking, what's my down payment? Oh, that's the number I'm bringing. Well, it's that plus that $3,000 to $4,000 of hard costs plus another $5,000 to $6,000 of prepaid items. That it adds up. So you got to plan for that, and make sure that you have the funds coming in for your transaction from a source that we as lenders can use, which is going to be things like money you've saved up on your own, money that you pull from a retirement account of yours, gifts from family members, or if you own another home, you could take out a home equity line of credit to help you buy that next house. Like, those are kind of the main options. You can't use personal loans for down payment. The gift has to be from an approved source, and every loan type has rules on who that is. So you have to be careful with that.
Yeah, I guess the only other thing that kind of comes to mind to me on that, and we can talk about briefly, even though it's been a little bit harder to get them in the past few years because of the way the real estate market has been, but seller concessions can help bring that number down as well.
Yeah, so seller concessions, as you know, are going to be where you negotiate into the purchase contract at the time of offer that the seller will pay some of your costs or all of your costs for you. And each lending institution or lending agency is going to have different caps on how much that can be, but that can greatly reduce the amount of money you're bringing to the closing table. And just as a lender here in the Lansing area, I see a pretty good number of files that get seller concessions. So it's certainly not a dead thing that you can't negotiate anymore. It's out there, and we do see it.
2020 through like 2022, 2023, it was really tough because the market was such a strong seller's market. It's still a seller's market, but it's not as aggressive as it was. So we are able to get more of those approved from sellers now than we could, like I said, in that 2020 to 2022 time frame.
It was tougher, but I think too, the thing that you need to keep in mind when you're thinking about seller concessions is what's the net that the seller is going to get.
Yeah.
If you come in at $300,000 and you need $10,000 in seller concessions, well, the seller net starts at $290 there. Whereas if someone else comes in with a $295 offer, that number's lower. But if they have no concessions, that seller's starting with $5,000 more of money. So sometimes you need to go a little bit above asking price to build those in. Sometimes you don't. But it's something that if you have a good realtor, they're able to work through that with you and make sure everybody can be happy.
Okay, Joe. Well, that pretty much wraps up all the questions that I wanted to ask for the audience today. I'd like to end with asking, do you have any advice or anything that you would like to share with people who are thinking about purchasing a home, getting ready to get a loan this year?
Yeah, like we kind of talked about earlier, is start early, and you can never start the process too soon, and then associate yourself with real estate professionals that are good, trustworthy, and will take care of you. And that's both your lender and your realtor. There's certainly an overriding feeling in my mind as a local lender here in the Lansing area is that and you can please speak to this, but I think our realtors in Lansing prefer local lenders, someone that has a brick and mortar here in town that I think there's just something to that here. Yeah,
brick and mortar and a good reputation. Just like anybody out there, not all lenders, not all realtors are created equal. So make sure you spend some time to do due diligence to get a great team of a local lender that has expertise in the area and has a good reputation, paired with a real estate agent that is in the same situation, is definitely a good recipe for success.
Yeah, absolutely. And I see this a lot with first-time buyers, but you can also take some of that too far. It's like, I'm shopping rates, I'm shopping lenders, I'm shopping realtors. You can really make your head spin. There's a lot of really good and talented people in this area to help you. Talk to a few of them and make an informed decision, but maybe don't talk to 20 of them, because you're going to really frustrate yourself and kind of start the process off with some feelings that you didn't really need to have from the get-go. You want it to be a smooth, happy transaction that when you look back on it, you're like, hey, that wasn't as bad as I thought. And we do hear that a lot, and that's something that you should get to.
So what I'm hearing is start early, make sure you got a great team to support you. You should be good to go.
Yeah, absolutely. It's not as complicated as you think. Just have people that you can trust.
All right. I think that's everything for us today. Again, I am Brooks Warner, local real estate agent with Mitten Home Team at Keller Williams Realty. If you have any questions about what we talked about today, please drop them in the comments. I'll make sure to answer them. You can also email me at brooks@mittenhometeam.com. I'll be happy to answer any questions. And I'm sure that Joe is comfortable with you guys emailing and asking him any questions as well. What's a good email to get a hold of you, Joe?
The letter J, last name White @vandykemortgage.com, and there's no E in Van Dyke.
Okay, awesome. Before we wrap up, don't forget to subscribe, like, share our video with anyone you know who's thinking about buying and wants to know how the loan process works. Thank you so much, and have a great day.